Hello and good morning, listeners. This is Almus Market Mornings with Shikhar Garg, bringing in the global financial updates. The US CPI came as per the market expectations, having some moderation in place. The year on year number released was sub 5 for the first time in 2 years at 4.9%. Moderating inflation and debt ceiling discussions have created massive turns in the yield curves. Longer tenors continue to drop while the shorter tenors continue to rise. On the other hand, the Chinese inflation marks the slowest pace at 0.1% on year basis and also showed a decline of 0.1% on month basis. Now, that's quite interesting to watch as most of the nations are struggling with inflation currently. Struggling with inflation, if we have to talk about Europe's high inflation worries are making ECB officials to accept the possibility of further hikes. So, JK, there's too many things going around. What's your view? What should we be watching out for?
Yes, Shikhar, this is the week of inflation watching for the market. And as you said, US inflation numbers are obviously the most more closely watched numbers because Fed always takes the lead in the monetary policy. And the monetary policy of the US has its influence on almost all the markets also. So as you said, we had inflation on headline dropping below 5% for the first time since April 2021. And in core also saw a drop of 0.1% as expected. That is from 5.6 to 5.5. But the important thing, the super core inflation, which is the new favorite inflation gauge of Fed, which is nothing but trade prices that exclude food, fuel, shelter, and even used car prices. And this has moved down from 6.1 to 5.2% year on year. And the Fed has moved their focus to this as even core inflation measure, which has become less relevant for reading inflation trends in the current environment, because the housing data that is used in inflation measures come with a lag. So it has also been volatile due to changing migration trends, and during and after pandemic, and that has affected the home prices. So the big component of CPI, that is shelter of CPI, also came in a bit weaker, giving markets some relief. So even the details of the CPI have actually been comforting for the investors, and that is very well reflected in the yields that came off across tenors. In fact, the Fed fund futures show that traders are pricing in a pause in rate increase by central banks at the June meeting, and less than 5% chance of another 25 basis point hike compared to around 22% probability before the data release. However, in my view, this is still not mean that there will be aggressive rate cuts by the Fed, which the market is discounting, because the absolute inflation number is still quite high. And unless we don't know, unless there is some event or huge hit to the economy that we see, I think the kind of rate cuts that the market is pricing in may not actually be so. And that is a view by many of the investment bankers that is actually being aired now. A 2-year yield fell by about 12 BPs and 10-year by 8 BPs. So at least for now, the markets are comfortable buying the bonds once again. And unlike the bond market, stock gains were much muted, as markets had still been having overwhelming concerns on the debt ceiling stalemate, as well as probabilities of a recession in the economy. As per the dollar, it retreated mildly after the data, but later stayed within the narrow range, awaiting more clues. We will have PPI today, and also the economy when weekly jobless claims are announced. But the fact that dollar losses after the week number was limited establishes that the market is already quite short. This also means that the positive factor can see a sharper up move as a correction in the dollar. Today's focus will be more on sterling as we head into another rate hike by Bank of England. And it is important to see what statement BOE makes after the meeting. And so long as BOE does not make a further hawkish statement, we expect some selling in the sterling on profit taking. Also on the ECB, while many ECB speakers have been out in force calling for rate hikes, more rate hikes. There has been some pushback yesterday by some of the speakers like Franz Wilroy, who said that there's only a marginal distance left to cover as far as the rate hike is concerned. And then Mr. Muller hinted that the scope for a pause in the cycle, saying that the rate rises so far have been fast and that we have reached a level where it's reasonable to evaluate what effect the economy has from the past rate rises. So there is some sort of pushback against the hawkish statements, which also might have been the reason why euro has been very slowly slipping. We look for more information about price pressures in the US with PPI numbers to be released at 6 p.m. tonight. Expectation for higher month-on-month numbers, but moderation in the year-on-year. As I said, China also announced inflation numbers for April sometime back today, and the price pressures there has eased both on month-on-month and year-on-year basis. That should keep the easing bias of a Chinese central bank intact. In fact, we have seen the Chinese yuan weaken post the data on perception of yield difference with the US remaining negative or even widen. On the rupee, after having broken out of the tight range, the currency settled above 82 yesterday, but lacked momentum to build the upside, probably as market awaited key data on inflation and development on the debt ceiling issue. Meanwhile, there was selling interest resurfacing at 82.10, capping the upside. While the downside does appear well defined by central bank, there is the lack of factors to give a directional move. Ensuring that we will stay in the range, and probably near term we move between 81.80 and 82.20 on the USD INR until we see some very big market moving factors. Thank you.
Okay, JK, that was quite good. And yes, I really like how the market continues to move around with some new favorite of theirs every now and then. And it's the new favorite of super core inflation, as JK mentioned, which is being quite, focusedly watched on. And it has moved down quite well. But yesterday's release has done something quite interesting. The possibility of another hike by the Fed as we speak is at 0.3%, which is quite interesting to watch, as most of the market participants have now gotten onto the side of a pause by the Fed. But do we have a hike by BOE today? It's more likely to have a hike of another quarter percentage point by the Bank of England. And on that front, as JK mentioned, we can expect some bit of profit taking on the sterling. There was on the domestic front some selling interest for the USD INR observed yesterday, but all in all, the currency pair remains in arranged action. There's also one development happening on the geopolitics side, wherein the China has put down cold water on the possibility of discussion between the US and the Chinese defense minister, majorly due to the sanctions dispute. So even though we are, or the financial markets are focusing a lot on the macro numbers and the inflation and other things, geopolitics does not looks like it is going to set on the sidelines and shall continue to rear its head every now and then, folks. That's it for today, and we shall come back again tomorrow with another round of updates. Thank you so much for listening.